I have my guest tonight. His name, Mr. Jack Schwager. Jack, welcome to the show.
Thanks. Glad to be here.
Thank you very much. Folks, if you're not familiar with Jack and Jack Schwager's work, he's written many, many books. In fact, most of the books he's written on technical analysis, fundamental analysis. In fact, he's also well known for his series of the Market Wizards book, the New Market Wizards, Stock Market Wizards, and, of course, just Market Wizards. And we're going to, tonight, ask Jack how that impacted his life and, of course, what he got and how the people he was able to talk with really did influence in his life in trading the markets and how he applies that today. You know, currently, Jack, you've got a lot of attributes. At one point, you got in the business. You've traded. You've written articles in Futures Magazine. You've been on a board of governors for the New York Mercantile Exchange, and you were mainly a research director for some of Wall Street's top investment companies. So you have an extremely colorful past and extremely proud contribution to the trading community, and I really want to get in and ask you a few questions if we could.
Sure.
Welcome aboard.
Thank you.
You're now currently, without putting the stigma of just an author, you're really known for your trading, and you're also known now as a senior portfolio manager for the London-based firm Fortune Asset Management, and you oversee the Market Wizard hedge fund. So you really have had quite a lot of accomplishments. What would you say was probably one of the most influential people and events that took you to where you are today in your life?
That's a good influential people. I guess that to some extent, probably I've been influenced by various traders I've interviewed in different ways. I can think of, you try to learn different lessons from different people. Well, let's just start with one, Michael Marcus, who's and a story unto itself, who's the first trader in the first Market Wizards book. And the irony there, we can talk about it later if you'd like, is that my first job on Wall Street was the research analyst job he was vacating, and we met as he was leaving the office and packing up and leaving, and I was coming in as a new replacement. But in any case, we became friends, and he went off to be a trader, and for a while he was still in New York, and we would get together and for lunch or whatever. And the thing that was interesting is I was always an analytical type, and I remember doing, at that time, analysis of the cotton market, and I analyzed every single cotton market back to the post-World War II period, and when would the market reach its highs, and what the carryover ratios were, and what the government regulations were, and everything else. And I came up, remember at the time I'd come up with the conclusion that, cotton's probably going higher, and I think at the time it was about 25 cents or so. But I said, if it gets up to about 33, 34 cents, that's about as far as it can go. And at that point, you'd almost have to start looking. In the mid-30s, you probably should be looking for a top in the market. Fundamentally, it would not be justified beyond there. And that was basically, on all this analysis I had done. Michael, on the other hand, the cotton market did go into a big bull market. And Michael, however, he kind of just saw this, that there was like all these fundamentals, but there was one key fundamental. He was a guy who could look at 100 different things and just know which was the important thing. At the time, the important thing was PRC was becoming a big buyer of cotton for the first time in history, and that demand he understood was going to drive cotton to unseen prices. And even though we had never gone beyond the mid-30s, even the more bullish, so-called bullish statistical balances in the post-World War II period, that particular market ended up going up to, I believe it was 99 cents, up to actually, ironically, just about the post-Civil War high. Most people don't actually even know that back in the Civil War, it's a big piece of esoterica, that back in the Civil War, cotton went up to $1, which, inflation adjusted was an enormous price.
Right. I think
and this was the highest, the one time it got up in modern times, it basically reached that level again. But he kind of saw this because he saw it as the one factor. And it made me appreciate that, markets, where markets are going to go, it's not just pure analysis, that there are, and you can't put it into a box, and that sometimes just being able to have the insight of what is the one key thing is much more important than being able to do any elaborate analysis. And so that was model, so to speak, of how to assess a market and appreciate it for what it was, without getting yourself boxed in because you did all this analysis and your econometric formula tells you should be this. Well, it was an important lesson, I would say. So that was like one early influence. And then there have certainly been others, if you want me to go into it.
Oh, sure. I mean, share with the listeners. I mean, the show is about helping listeners learn.
Here. Another trader that who became a friend, and I'd interviewed for I believe it was my second Market Wizard book, New Market Wizards, a fellow by the name of Tom Basso. And one of the things that came up in my interview with him was it was the markets at the time of the first Iraq War. And he had a position. He was long energy markets at the time, long crude oil, so forth. And if you recall, when that war started at night during the after hours market, gold rallied very sharply, crude rallied very very sharply. You had these real huge spikes when the war started.
Right.
But but overnight it turned. In fact, that may be that particular overnight period, I think probably is by far the most extreme overnight move that has ever occurred in any market. I may be wrong, but I can't think of anything more extreme. Anyway, he talks about the next morning he's in bathroom, shading or whatever he's doing, and the TV's on in the bedroom and the news is on, and he kind of is listening to the background while and he thinks he hears crude. He went to sleep like crude had gone from 28 to 38. And he thinks he hears, crude, like $22, something like that. And he doesn't know if it was a 22 or was it 42. He can't believe it's 22. He said it must be like 42. And he walks out, and he asks his wife, did he say 22? And his wife says, I wasn't listening. Well, it turns out it was 22. And what had happened is the market had built in all this anticipation, and as soon as the war started, decided, well, that's it, and it was all over discounted, and all these markets, gave back all the stuff they had built in, and of course it gave back the extra, the first spark up they got right after the war started.
So pun intended, he may have gotten nicked while he was shaving.
Yeah, he got more than nicked.
Yeah.
So anyway, but here's the point. So I asked him, well, how the hell does that feel? You go to sleep, thinking you've got this tremendous windfall profit, and you wake up and you've got this phenomenal loss. And he said, it wasn't bad. Really, he said, we'd been planning for this all along, this type of situation. And I drove to the office, got there real early. If my, trader, we got all our orders in. We did everything. All our signals, everything had gotten kind of signaled, and he's working on a systematic approach. Put all his orders in. Everything got done. And after, 10 o'clock, kind of leans back, and it's all over, and it's done. And, sure, it was it took a big loss, but, hey, he said, well, they went through their crisis, they did it, and he felt pretty good. Well, I said, gee, that's a pretty good attitude, the attitude was, well, he did what he had to do, and he's following a system, and that's life, he's not gonna get all emotional and, depressed about it, and that's a terrific role model. Unfortunately, most people can't do that. I wish I could be that way about it as well. And in fact, one of the reasons I personally don't feel I'm a good trader as kind of a trader sitting at a desk making trying to make trading decisions. In fact, I don't do that. Is because I have that emotion. I don't have that ability to really remove myself. I mean, Tom can kind of look at himself almost as a third person. Like he uses the analogy of watching a movie. He's watching himself in a movie almost. He can kind of take this out of body attitude to it and not let it get him down. I'm not quite that good at it.
Emotions of steel, almost, is what you're saying.
Well, it's not steel. It's almost. I'd say it's more like rubber than steel. He's just very flexible. I mean, that's the way it goes. It's like. I had one trader use well, it's not quite but the analogy of being a jellyfish and just kind of going where the current takes you, and he was using it for a different reason. But that it would be more like that. It's just taking it as it goes, without kind of trying to fight it and getting all emotional about it.
Well, those are some good stories there, and I think the important thing is that you'd mentioned that you yourself stick with system trading. Folks, when we get back, my guest tonight, Mr. Jack Schwager, and we're going to talk about trading and how Jack applies what he's learned through the years and the wealth of information that he's going to help pass on to you. And we're also going to ask Jack a slew of questions come back. Listen to this interview with Jack Schwager, my guest. Of course, he's also running a major hedge fund, and he's been an author of some of the best-known trading books, the Market Wizard series. Jack Schwager. This is John Person. We'll be right back. Welcome back, everyone. With me tonight, my guest, Mr. Jack Schwager, author of many books, particularly the Market Wizard series. And we're going to get into asking Jack what, more importantly, his philosophy of trading is and how he has applied what he's learned from others in his vast experience. Jack, welcome back with us.
Okay, thanks.
Jack, can you convey what worked for you? You did a lot of interviews. You've done a lot of books, mainly fundamental and, of course, technical analysis. What really has been one of the more instrumental methods of trading for you?
Okay, well, first let me say that what works for me is in some ways irrelevant, because one of the messages I try to deliver, it's actually one of the themes that came out of the Market Wizard books, is that people have to find an approach that fits their personality and who they are and so forth. So what's right for me is right for me, and really doesn't make much difference to other people, because it may be right for some people in the audience, but it'll be dead wrong for others. So but having said that as a proviso, I'll tell you what the answer is, but I don't want people to extrapolate that there's any.
No, that's a great answer.
The right approach.
And that's a great answer. That's the correct answer, Jack.
Yeah.
Thank you. Because everyone is different, their personalities, their makeups.
Yeah, and I often get people, say, well, how should what approach should I use, or they're asking to be given on a silver platter the methodology that they should apply, and it's a nonsensical question, or another way to put it, they not only don't have the answer, they haven't yet found the question. Because everybody has to basically find their own approach if they're going to be successful. I have never interviewed a successful trader who basically said, I had Joe X sit me down by his side and tell me exactly what he does, and that was the right way to trade, and I've just followed his guidelines, and I've been successful ever since. I mean, nobody I ever interviewed ever became successful because they mimicked or followed somebody else. Yes, there may have been some people they learned from. There may be some people who were models in some way, but every successful trader always develops their own methodology and their own approach, and it's critical that each person find their own approach, because otherwise they're gonna fail. That's a characteristic I found that's true of all successful traders. They find an approach that fits their personality, and let me illustrate this with a couple of examples. I'll take two of the people I interviewed. Okay, take on one hand somebody who's fairly well known, as Paul Tudor Jones.
Very well known, right?
One of the great. What's that?
Very well known.
Well, very well. Probably one of the best known, traders of our time. Now, Paul, when I arranged to do the interview, told me, come down to my office around 2:30 or so, and we'll do the interview, or 2, whatever it was. And I said, Paul, I know you trade very actively during the day, and I can easily come after market hours. It might be better, and so forth. He said, no, that's okay. Just come at 2:00. And so I come at the appointed time, and Paul's in this big office, and he's got desks, phone, bank of phones on his desk, with direct lines to the floors. He's got multiple screens. And all of the interview, he's watching, he's shouting, and he's got open lines to the floors. He's shouting orders, sell 300 March S&P, buy 500, Feb Gold, whatever. And he's doing this at the same time he's doing the interview. He's got phone ringing, people calling him with information. He's got people bringing in messages. He's doing the interview back and forth, that's kind of Paul. I mean, at least it was at the time. This is a bit back. This is now the late 80s I'm describing. I don't know if he's changed or whatever, but at the time, at least, that was the way Paul traded. I mean, just like a barrage of stuff going on, trading multiple markets, taking information from everybody, doing an interview at the same time. That was him. Okay, that's one image, and that works for him. But that's his personality. Very aggressive, somebody who's kind of looking to kind of catch the turns in the market, somebody who's quick to act, somebody who can take a lot of information at one time, make quick decisions, et cetera, et cetera. Okay, one image. Take another image, a fellow by the name of Gil Blake. Gil was he was a chief financial officer for a company, and was not involved in trading whatsoever. In fact, just no interest in it or whatever. One day, a fellow comes into his office, or one of his colleagues, and he says, "Hey, I've been fooling around with this, and it seems like I can buy mutual funds, and sell them out, do fund timing, and I can do this, using a simple methodology, and it seems to work, and I seem to kind of make money fairly regularly." And Gil listens to what he's doing, and he says, take a look at that and see if I'm missing something. And Gil says, well, I'm sure this is too simple. You're obviously doing something wrong. This is obviously not going to work. So he takes it and he kind of analyzes it, and sure enough, it did work, and he was kind of surprised because it was that market inefficiency. Once he kind of realized that, he started doing much more rigorous analysis and came up with much more effective approaches, and came up with methodologies that really were quite startling in terms of their return to risk. And in fact, when I had interviewed him, he had like a dozen years of trading behind him. He had average return of about 45%. His low year was about 35. His high year was about 55. So very consistent. He had only 5 losing months out of the whole 12 years, and his worst peak to valley drawdown was less than 5%. So quite an amazing record. But anyway, the thing about Gil was he's a very soft-spoken guy, very modest guy, and he also he traded on he would go to the way he did his analysis. He would go to the local library and go through microfiche. I mean, this is not even using a computer. He would go through these just reams and reams of numbers and look for patterns. And he'd like I say, spend weeks in the library doing this, and just on his own, and just looking at numbers, and then come up with some patterns and go, and he would trade the system, from his home office in his bedroom, Wow. Okay, now I tell people, can you picture, given those images, can you picture, Paul Tudor Jones sitting in front of the microfiche and kind of looking for patterns, or could you picture Gil Blake in the environment that Paul Tudor Jones thrives? I mean, it doesn't work. But each one was enormously successful because they were using an approach and a methodology that fit their personality, and you couldn't be more radically different.
Well, that's kind of an interesting point, that everyone's personality needs to be kind of a different method of trading. You've mentioned someone that's very good at numbers. He goes and he looks at microfiche of all this information of Gil Blake, and then you have on the other spectrum a guy like Mr. Paul Tudor Jones, who he can do 20 things at once and then still do an interview with you. So the mindset, and so for you. And now you've illustrated, and I think that's probably, out of all the guests that we've had on the show, and I'm sure you know John Bollinger very well. I asked John, I said, John, what would you recommend to a new trader? Because a lot of people, Jack, are getting into day trading on their own. And I said, John, what would you recommend for someone to do? And the first thing out of his mouth, he says, you're thinking he's going to say, buy my book, or buy Jack Schwager's books, or buy John Murphy's books. First thing out of his mouth is, if there's a local community college, they should go down and take a course on human psychology. And then they would understand how they would work and relate to themselves and the markets. And I thought that was kind of an interesting point. And you come out and you say, well, John, my method of trading is different than any, it's not different. I mean, I look at a chart, you look at a chart, we all look at a chart. It's how we all react to that chart, or we're able to put a trade on. And I think as traders or investors, people need to realize that how we interpret and analyze the markets, we could see different things, and that's what makes the markets. There's this old saying that if you want to play tennis and you want to get good, always play with someone that's better than you. Hang around the winners. And Jack, you're certainly one of the winners. And so people want to hear from you what's always worked in your case. And I think that you have a lot to share, and we definitely want to hear what exactly are your styles of what do you use when you look at a market?
Well, okay, again, so that comes down to what my biases were and so forth. I personally had favored just classical type of chart analysis, and when I say classical chart analysis, it doesn't mean you just buy the breakouts. You have to learn kind of how to interpret charts in your own way. What's important, and one of the things I always did was I paid more attention to classical chart signals that failed and those that worked, that when the market followed through, because I thought failures were actually a more important signal than the actual signal. But that's just like my own kind of bias and twist and whatever. So
that's an interesting point. Can you elaborate a little on that?
Well, sure. You take chart what looks like you've had a good run up on the upside. You consolidate tightly. The market looks like it's about to break out on the upside. Breaks out hugely. Trade, closes strong. Trades up there for a couple of days. Looks like it's going to take off again. And then, all of a sudden, kind of one day, and then there's some, news which sounds pretty good. Market's up a little bit during the day, but then actually closes down a little bit for the day. And then it kind of drifts lower. And, a week or two later, you're actually below where you broke out from. And, background news has actually been supportive. Stuff like that. I mean, that's actually, the fact that the market broke out and didn't go anywhere and has kind of pulled back below the breakout point and it's had supportive news and has still done that, that's actually better information and more reliable information that market is probably going down than the original breakout was a signal that the market's going still higher.
Thank you very much. That was a great point. Thank you for sharing that with us, Jack. When you have, like, for example, if people are looking at traditional chart patterns, such as a bull flag, and the market seems as it should take off, and all of a sudden it fails. Those failed. Some people say you do a reverse on your position. If you were long and the market looked like it was going to accelerate to the upside on a bull flag formation and starts to fail, possibly look at reversing your position. Do you do some of that type of trading too?
Yeah, I mean, I think ideally that's what again, I'm not at the current time. I'm not trading anymore. As I'm acting as a portfolio allocator, and and actually even on the trading side, I haven't traded for many years because one of the things you asked me, what do I do? What's my style? Well, I decided a long time ago that making trading decisions, in real time, emotional decisions, that type of thing, was not my cup of tea. It's not what I really felt comfortable with. I felt comfortable with more of analytical approaches. And so I had gravitated to a purely systematic approach. And when I was involved in trading until a few years ago, it was strictly through a systematized approach. And at that point I decided I was going to go the route of getting involved in running a fund-to-funds portfolio, and that's what I wanted to do. And I felt I could find traders that are a lot better than myself and put them together in a good portfolio. And that became the direction I went. So that's what and I don't believe in doing two different things at one time. You kind of focus and do your attention at one thing to get the best result.
Well, when we come back, we're taking a quick break here. We're going to talk about this methodology that you have about this funds to funds that you're now overseeing. Folks, Jack Schwager, join us. We'll be back in just a moment. Welcome back, folks. With me tonight, my special guest, very honored to have him, Mr. Jack Schwager. Jack, welcome back with us.
Thanks.
You wrote these books, the Market Wizard series, and what you did, just to review for listeners that just joined us, you wrote these books and you were able to write down the key principles that these traders that you interviewed, what they defined success. It's helped a lot of readers. You've had, from hedge fund managers to traders to brokers all over the world. In fact, your books are written how many different languages, but you were mentioning that you actually had this book, it's published in Chinese in 2 different dialects of Chinese.
Yeah. I don't know how many translations there are at this point, but I think it's upwards of, it's certainly double digits. But the ones I appreciate, of course you expect, French and German and all of that, but I get the kick out of the esoteric ones. So the first Chinese I thought was good, but when I got and you had virtually no money, especially if they sell the rights to China. You wonder, it doesn't seem like it can cover the publisher's legal cost. I don't even know why they bother. But in any case, it was published in Atlanta. They translated a second Chinese dialect. Actually, I think Turkish was one of the other unusual ones. So there was a Turkish version of it.
Wow.
Yeah, so you're kind of interested, in places you really wouldn't think you would have a translation of a financial.
It's almost like the book, the futures trading or the stock trading, the trader's book of similar to Harry Potter proportions. So
well, not quite. Unfortunately.
Give it time, Jack.
Although when one of the Last Wizard's book came out, and there's a review in the Wall Street Journal. For that day, it did get ahead of Harry Potter, and on Amazon, and there was one point where it was like above Harry Potter, so I copied that, I printed that page. So for about 3 seconds, it was ahead of Harry Potter.
Well, you trade now based on a methodology of returns using basically looking at a fund of fund. And that's something that some people may not grasp the concept. And you look more at returns versus risk. Could you describe that for us?
Sure. I mean, it's two separate aspects. And I'm going to talk about it generally because, as you know, when you're dealing with hedge funds, you really can't talk specifically about any hedge fund product or whatever. So I'm going to talk about just principles and the concept of fund of funds in general.
Well, that's great. I'm going to say this. The reason why, because a lot of people are throwing money into the markets. Managed funds, managed futures are something that's becoming more popular. People hear the word hedge funds left and right. They associate it with derivative trading, and they really don't know much more detail about it. So, by having you on, having to describe that, I think is excellent. Thank you.
Sure. And just to get some definitions correct. And the thing with hedge funds, the reason why one really can't talk about it in a public forum, any specific hedge fund, product, is because, investors have to be accredited. And, you're talking to radio, you haven't determined that your whole audience is accredited. I mean, I suppose if you could do that, you could probably talk about a specific fund. But, okay, so let's get some definitions straight. First of all, you talk about there are funds that are, futures or futures-oriented funds or CTAs. And the lines get blurred here a bit, but those traditionally have been one class of funds, and they're funds where, as the name implies, the manager, they're called commodity trading advisors, which is kind of I always thought was a terrible name because, the fellow, the commodity trading advisor is not advising, his investors. He's trading, he's managing the money. So I don't know how they come up with that name, commodity trading advisor, but that's what it is. But a commodity trading advisor and a futures fund or a CTA fund is a managed fund in the futures markets, and often also may overlap into the FX market and use interbank instruments as well, and so forth. Hedge funds, now that's a really tough one because hedge funds originally. The original hedge fund, the very first hedge fund, which was considered to be founded in 1949 by A.W. Jones. But the original hedge fund, what Jones did, and this is an interesting story. This is kind of a little interesting background on hedge funds in general, particularly for people who aren't familiar with it and how this all came about. And people have a total misunderstanding of what hedge funds are. But it's interesting to know what the origin is. The origin is this fellow A.W. Jones, who was a journalist actually. And he was writing about funds and so forth over a number of years, and came to the realization that that really nobody can really successfully time the markets, but there are people who actually can pick stocks. And he thought, it makes more sense to kind of buy stocks you think are good, and against that go short to some extent, hedge it with stocks you think are poor fundamentally relative to the price, and to make up for some of the lost return because you're going short, eating away some of the upside when you have an advancing market and stock market secular up market. You use leverage, and the combination of that of somewhat short against the long and leverage would give you a better return risk than you can possibly get if you just tried to buy stocks. And what happened, the way he became famous and the way hedge funds became famous, was that after he had been doing this for 10 years, someone wrote an article, a woman by the name of Loomis, I forget her first name, and I think it was unfortunate this article appeared, and it turned out that this hedge fund that A.W. Jones found was a top-performing fund in the prior 10-year period. In other words, it beat every single mutual fund for that 10-year window. And moreover, it was also the best performing fund for the past 5 years. So you took the best 10-year performing mutual fund was not the same as the best 5-year performing mutual fund.
Well, so Jack, we're going to break for commercial. Hold that thought. We're going to share that with folks. Folks, Jack Schwager talking about managed funds. We're going to be right back. This is John Person, your host with the Personal Investors Hour.
Don't go away. We'll be right back with the Personal Investors Hour with John Person.
Hey, welcome back. This is John Person, and with me tonight, my guest, Mr. Jack Schwager. Before we left, Jack was talking about hedge funds and how managed funds work. Jack, welcome back.
Thank you.
So, back to where we were.
Yeah, so where we were. So anyway, so that's how hedge funds began, and then back in '49, and when that and when that story came out 10 years later, or a little over 10 years later, that's where they started becoming a bit popular. That was the initial birth of hedge funds, but they didn't really become big until the 1990s, and they I won't say mutated, but they turned. There was a lot of different concepts that started being done with the same legal structure of fund. The legal structure being one where the manager, for one thing, the manager charges, earns not a management fee, but also partakes an incentive fee on the returns, which is also something that CTAs and futures funds do. And that's one of the major differences between hedge funds and mutual funds, is that they're incentive based for the which makes it, of course, very beneficial to the manager if he does well trading. So and it kind of aligns the interest as well. But there is no real kind of one strategy for hedge funds. I mean, the one I gave you is called the Classic Jones model, and that's kind of maybe the most common or popular type. It's called an equity hedge fund, where essentially, just like the name sounds, it's an equity fund, but there's a hedge on, and usually combined with some leverage. Okay, but there's also fixed income types of funds. There's all sorts of arbitrage funds. There's convertible bond arbitrage, statistical. We could do a 10-hour series on all the different types of strategies and everything that's out there. The idea to get across, though, is simply that there's a tremendous array of different types of strategies that are used in hedge funds. Unlike the traditional fund world, where you comes in two flavors, chocolate and vanilla. You're either, chocolate being, I guess, long stocks, and vanilla being long bonds, and that's, pretty much it. And you can kind of mix those flavors somewhat, and you know what, one brand chocolate is going to taste pretty similar to another brand chocolate, and you can't get too much variation by taking different brands of chocolate. But in the hedge fund world, you can put together a portfolio of 30 or 40 different types of strategies. You can put together a portfolio where on average the correlation of all the managers, all the funds in that portfolio is pretty close to zero. And that ability to diversify to that extent is something that makes it possible to construct a fund's portfolio using hedge funds, and also futures funds that has a much lower risk to it than a traditional investment, simply because you've diversified across so many different strategies. So the irony here is that many people think, gee, hedge funds, that's really risky. Well, yeah, I mean, a hedge fund could be, if you pick one hedge fund and you kind of, don't pay attention to all sorts of, due diligence and concern about volatility and everything else, and you kind of shoot from the hip and just take somebody who's made 100% and put all your money with that, yeah, I guess it could be risky. And also, there's the occasional fraud that comes out, 1 out of 1,000 funds or whatever the number is. So if you don't know what you're doing and you invest in one fund, it could be quite risky. But investing in a very diversified group of funds is actually a very low-risk venture. In fact, fund of funds, on average, maximum drawdowns for fund of funds typically tend to be, under in single digits, and sometimes under 5%, and they could actually be even lower. And that compare that to the long stocks or even long bonds, where 10, 20, 30, 40, or NASDAQ 70% the drawdowns are not happen.
Yeah,
so,
and that's your niche now, and this is what you've discovered.
Well, yeah. So I really believe in the idea of a fully diversified portfolio. That's what I believe in. In fact, that's what I wanted to invest my own money in, which is why I ended up doing that. And so I believe in that as a philosophy. People sometimes say, well, what do you think is what percent of my money should be in, is conservative in hedge funds? And the conservative advice is, 10 or 20% or whatever. And my thought is, really 100%, because I think it's a lot safer, because 100% allows you to diversify across so many different strategies, some of which may be long biased equity trading funds. That could be part of the mix as well. But if you do it right, you can create a product that has much lower risk than the traditional type of investment. And it's really ironic, people kind of pigeonhole hedge funds as being risky. Really don't. They can be if you don't know what you're doing.
Right.
But it's oddly enough, if you looked at well-diversified fund to funds as a group, and I'm talking my own fund. I'm just talking about the group of fund to funds. The risk there is much lower by any measure, by any statistical measure, than any type of mutual fund that you can care to name.
We're going to break for commercial. When we get back, I have a few questions to ask you, Jack. Some of the tips, tricks, and techniques that you would probably say, hey, here's what I saw when I first started out. And I think you've already given us one of the best one, and that was diversification. Sounds like that is the old adage. Diversification is the key to success, and you're applying that today. Folks, Jack Schwager. We'll be right back. Hey, welcome back, everyone. This is John Person, and with me tonight has been my special guest. Very honored to have him, Mr. Jack Schwager. Jack, welcome back.
Thank you.
First question I'd like to ask you, if I may. If you were going to tell a new trader just one thing before they started to trade and they were thinking of investing, what would that one bit of advice be?
Well, first thing is read. So, the easiest thing, books are relatively inexpensive. There's a wealth of information in them. And so the first thing to do is, you're new to the markets, you're interested in markets, just read a lot of background stuff. If you want to be a doctor, you wouldn't just go out and, try to practice. You'd actually hopefully learn some medical knowledge and, whatever before. There's kind of people have this insane idea that they could just, start trading. Because, hey, John down the street has just made, $10,000 in a week because he hit the stock right, and I could do that too. Well, sure you could, but you could also, but John and you can both lose everything and plus some. You have to kind of prepare yourself, and part of the preparing is get some knowledge, and knowledge, the easiest place to get knowledge is just out of books. So there's tons of good books out there, and so the first thing to do is, I think I'd spend a lot of time just reading and getting information, and so that's a starting point. Okay,
what was your favorite book when you first started to trade?
Well,
what was your favorite book?
The book that kind of was an inspiration for me, and the book that was my role model when I wrote my first Market Wizards book. My goal was that I wanted to be the next Reminiscences of a Stock Operator. Reminiscences of a Stock Operator, which I think will be a book familiar to many in your audience,
yes.
Is a book that was written back, I think in the 1920s or so. It was about Jesse Livermore. It was written by Edwin Lefevre, and now many people mistakenly believe that Edwin Lefevre is a pseudonym for Jesse Livermore, and they believe that because the book so well captures the mind of a trader that they really thought that Livermore himself had written it. Not so. There was actually an Edwin Lefevre. He was actually a writer. He wrote other books, some on financial markets. In fact, I spoke to. I did the foreword when after the 75 years time limit ran out in the book. John Wiley, I believe, was publishing it, and I ended up writing the foreword for that book.
Oh, fantastic.
But in writing that foreword, one of the things I did is I got a hold of his grandson, who was like about 85 at the time, and spoke to him about his grandfather and so forth. So
right.
So Edwin Lefevre was a real person, and it wasn't just him. But anyway, that book is classic because it's amazing how little things change. That book was written in the 1920s. It's as timely today as probably when it was written. And as I said, my goal in writing Market Wizards was to have a more modern-day version of a book that captured, the mind of a trader in a different format, but would have that same type of longevity because the lessons are really timeless.
And I think you accomplished that. Thank you. Jack, if you could, and you were going to tell a seasoned trader, someone that's maybe been in the markets and studied, he's gone jump to jump from method to method, what would you tell him if it was just one thing? What would it be? Well,
the one thing is you don't commit too much until you're really confident. And, that's one of there's lots of traits I've noticed in successful traders, and one of them is confidence. I mean, really strong confidence. And people often, want to know, kind of want to trade and everything else, but they kind of have a little bit of a reservation and not quite sure that their approach is the best, or maybe they need to change it. And all of those signs are indications that the trader doesn't really have full confidence. And my message would always be is really don't commit heavily. Or maybe you want to take a small amount of money and learn how to trade and trade a little bit, but don't really make any large commitments until you have real confidence. And how will you know when you have confidence? Well, it's one of those things. When you have it, you'll know it. It's like you either have it or you don't have it. And if you think, well, do I have confidence? You don't have it. You have to have it as a very strong feeling. And it's almost unmistakable when you interview someone who has that sense of confidence. It does really come across.
It comes across. It seems that it's something that you learned. I mean, and you experienced yourself. What was the best lesson you ever learned when you were trading? The best lesson you ever learned?
Let's see. The best lesson I ever learned was, let's say, what was my best trade? The best lesson I learned was my best trade. My best trade, which I still remember, and it's now about 30 years later.
Okay.
My best trade was, of course, a losing trade.
That's a surprising answer.
But when I say it was my best trade, it was literally my best. My best trade was certainly up there. It was my best, but I mean, none of it was my best trade because it taught me a lesson. I mean, it was my best trade.
Right.
And the trade specifically, the situation was, up to that time, I had traded largely fundamentally, and through the influence of an analyst who worked for me, my name is Stephen Kronowitz, and I was research director and I was also the fundamental analyst for a number of markets. And I'd hired him as a technical analyst, and I didn't really believe in technical analysis. But working with him, I saw he was getting calls right a lot, and I kind of became interested. And I taught him about fundamental analysis. He taught me about technical analysis. And I began to see that really, this is good because it gave you a way to time markets, and more importantly, it had a built-in money management to it. I mean, fundamental analysis. Hey, if I'm bearish on wheat and wheat's at $3, and I go short, and it goes, and the fundamentals don't change, and it goes to 320. Well, I should go short more, and if it goes to 340, I should go short more. And it has that's one problem with fundamental analysis is not only doesn't have any built-in money management, but it has the antithesis of negative money management. In other words, you should be adding more when the market's going against you based upon the approach. Well, technical analysis gives you built-in money management. Well, so this trade, I thought the market was a D market come down. It had been basing for like 6 months.
Jack, we got 25 seconds.
Okay, so I thought the market was going to bottom. I put a stop in right below the base. The market eventually broke the base. I took a tiny loss, a few $100. The market fell apart. I would have lost thousands if I had waited, and it taught me a lesson to always know where to get out before I got in.
Wonderful. Jack, we wanted to say you offered our listeners tonight something so valuable that I hope that they can take home back to their parents if they're still trading in the markets. You've been just a great wealth of information. Folks, Mr. Jack Schwager, get a hold of me, www.nationalfutures.com, and we'll show you how to get a hold of Jack Schwager. Go get his book, Market Wizards.
Content of this program does not constitute investment advice. This program is to help enlighten you to the opportunities for further education and trading techniques by industry leaders. It should not be considered as a solicitation to buy, sell, or invest in securities, options, or futures. Remember, trading does involve the risk of loss. Past performance is not an indicative of futures results. Futures and options is not suitable for every investor. Please consult a professional regarding your financial situation before placing a trade.